The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
Hello, my name is Jason Nickerson, President and COO of John G. Allman Associates. Welcome to this recording where I'm going to cover a little more in depth an article that I wrote some time back called The New Investment Strategy That You Should Consider. Now, to be totally honest and upfront with you right from the get-go, the reason I titled the article that way was simply to catch everyone's attention. And in all honesty, there is no new investment strategy to share, but I ask you to stay with me, okay? And the reason I want you to stay with me is because I want you to remember the phrase, what's old is new again. Now, if you've never heard that, you certainly have now. And I think it's something that we need to consider to reminding ourselves of, even in our investment strategy, right? Because I do feel that it's important for us to not necessarily jump into the newest, shiniest thing that comes along, especially when it comes to our investments. See, the reason I wrote the article was because somewhere along the way, I think we lost a little bit of the way we think around the importance of the money that we have saved and invested. We've lost a little bit of our sanity. See, we work really hard to earn the money that we have, and then we carefully plan and work on an investment strategy with our advisor, and we set reasonable expectations. But somewhere along the way, and I would say this has really been in development over the last 4 or 5 years, really kind of since COVID, something has changed in our investing psychology. Now, part of it I would blame, or maybe blame's too strong a word, on the fact that something Bill Gates, the co-founder of Microsoft, predicted in a book that he wrote, that we would all walk around with a computer in our pocket. We have access to information on a second-by-second basis, 24 hours a day, 7 days a week. And I believe that has shortened our attention spans. And as it has continued to evolve, and what was a real opportunity has turned almost detrimental, we're now seeing that on a very quick, short-term basis, but also we are acting on and paying attention to very bite-sized pieces of very important information. And so as paying attention, we're starting to act on those. Now, I'm not saying it's all bad, right? Because this is the information around the world is available to us anytime we want it. But relative to the importance of the money that we earn and save and invest, we need to take some very careful considerations about how we proceed with the actions that we take. So the new investment strategy I'm talking about is really just to stay long-term focused and allow yourself to continue down a path of consistency and discipline around your investments. So going back, this is really a psychology issue. It doesn't have much to do with strategy and math and planning in terms of what I'm speaking about, right? It is a psychology bias called the recency bias. This is where our decision making is heavily influenced to the recent information that we've just received. What are some specific examples of this relative to investments? Well, I would call one of them the GameStop effect. They even made a money out of this called dumb money, right? So it is what is happening on a short-term basis, take a little bit of information and take big actions off of it. See, I think there's some other things as well that have impacted just this psychology shift in the way we approach a solid long-term saving strategy. I think low interest rates have contributed to that. I think wild swings in the broader market have contributed to that. I think the performance of the top largest 7 to 10 companies really driving the market has certainly influenced our decision-making around investments. And so we have another psychology influence or psychological bias called FOMO, fear of missing out. It's a real thing. And so we see all of this information, not just coming from trustworthy news sources, but say people that we follow on the various social media platforms, and they post, look how well I did on this investment. What we're not seeing is how well they didn't do on probably several others. Now, am I saying that the events that have contributed to these volatile markets over the last 5 years haven't been fruitful? No, they certainly have. especially if you have implemented the discipline and consistency that I've been talking about, right? If your investment strategy is simply on the short term, what can I do day in and day out, and chase the big trades and the big money, at some point, you may be really lucky if you've done that, but at some point you're going to be on the losing side of that. There was a very famous person called by the name of Jordan Belfort. And if you know this name, he was known as the Wolf of Wall Street. He recently did an interview with Yahoo Finance where he suggests that the average investor loses all the time because of the latest hot stock tip. And in that article suggests that a long-term strategy is most important to structuring your overall long-term plan. See, even someone with the nickname Wolf of Wall Street gets this investment strategy that I'm calling new, but it's not really new. There's another famous person I like to quote by the name of Albert Einstein. Now, Albert Einstein, many of us know as more of a scientist. He wasn't even originally a scientist, and he was never in financial services or investments, but he understood one key concept to a solid investment plan. And he had a quote that I love to use all the time. It goes like this: compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So again, his point here is continued, consistent, disciplined investing and compounding earnings on that will help us reach our goals. Okay. So hopefully by now I've kind of convinced you that the long-term investment strategy that's withstood the test of time is still the best investment strategy to go on. But let's go through some actionable items that I think will stand the test of time even further. So first of all, I like to coach and advise people to start investing early. The earlier you start investing has proven time and time again mathematically that you actually don't have to maybe invest as much as if you had waited and started investing later in life. You start that compounding interest earlier in your life. I think the second thing to focus on is setting a long-term strategy for your saving investing, and don't get swayed by the hottest stock tip or the hottest investment craze, but a well-diversified portfolio that aligns with your goals and objectives and your investing timeline. And set that long-term strategy in place and stay consistent with regular reviews with your advisor. So one of the questions we get very commonly from people who are approaching retirement leads to my third point, my third recommendation. We often get asked, does retirement mean I need to get much more conservative? And I would say not necessarily, but it could. See, it really depends on what retirement looks like and the needs that you have to pull from your portfolio. But remember, most of us are thinking retirement around 60 or 65. Maybe some are earlier, some are later. But let's say it's age 60 with life expectancies up to 80, 85 years old, and we even hear of people living out to 90 or 100. That's a 20 plus year investment horizon, still a very, very long time. So retirement doesn't mean that we just pull all of our money out of the market. Frankly, that's probably not the right thing to do unless there are some special circumstances in your plan. But it's still keeping in mind that long-term investment strategy. Number 4, diversification still works. Even though that we've seen over the last 5 years, 7 to 10 companies dominate the performance in the market, those names have changed, and there will come a time where those names won't dominate. We've actually seen this historically, time and time again. I refer people back to what we're experiencing now with the AI craze and names like NVIDIA and Microsoft and Google. And some of those have been around and performing for a really long period of time. But I have them reflect back to the days of the dot-com bubble, and there were names like AOL and Yahoo. And those are names that really no longer exist or even talked about. So diversification still matters, because who knows what the next names will be that will perform well, and who knows what the next names will be that fall off the radar. And number 5, and I've said it and I'll repeat it, is stick to your plan. It doesn't mean that you don't have review points with your advisor, but it's important that you're not trying to change strategies every week, month, or even every year. Sometimes it's just about the long-term discipline and consistency to maintain that long-term investment strategy. Now, I know that this isn't very flashy. I know it comes across as boring, but it has been proven to work time and time again, that this long-term, disciplined, consistent approach with slight adjustments according to your plan and that come along with slight adjustments to your goals, it continues to work. So again, consistency, discipline, long-term mindset. This is the new investment strategy that I'm talking about that's not really new, but it seems new given the last 5 or so years that we have been seeing how the markets have been moving and how the focus has really changed. So get your foundation set, get deeply rooted in it, get committed to it, continue to review with your advisor. And if you stick to that for a long time, overall results should trend in the right direction for you.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.